class on price action trading, brought to you tonight by Alvexo, one of the world's leading providers of Forex and CFD trading. Sorry about that. Alvexo is a real broker for real traders. You can trade stocks, indices, Forex, commodities, and cryptocurrencies. And if you want, during tonight's webinar, you can go to www.alvexo.com and open up a free demo account and follow along using the dynamic advanced charts from Alvexo. And as you can see, their whole entire trading platform is simple. It's easy on the eyes, it's user-friendly, it's got tailor-made reporting, it's got built-in trading signals. Everything is fully customizable with their easy-to-use advanced charts right in the center of your screen. And you can use their proprietary unique web trader, or you can use any of the MT4 platforms, and you have access to mobile trading, you have the terminal download, you have Mac trading, whatever device you want to work on, and you can move from one device to the next, to the next, to the next, and work across all of your devices at any time seamlessly. And you have access to over 450 real-time price quotes with Forex, indices, commodities, shares, and cryptocurrency. And as you can see on my screen, everything is easy on the eyes. You know, I've come to some platforms from some other brokers that they're so complex, or they're so difficult to see, or the colors, or they just hurt my eyes. The Alvexo platform is comfortable. It's designed for your usability. And when you trade with Alvexo, you get cutting-edge technology, you get award-winning customer service, and you get a regulated broker with a regulated platform. Now, tonight's class is being recorded. And if you wish to see a recorded version of tonight's class, you can do so in about 24 hours by using the same link used to attend tonight's class. Now, because Alvexo is a regulated provider, I am required to give you a risk warning. And as I read along over the next few screens, I would appreciate it if you could read, because I'm only going to paraphrase, if you could read everything that's there, if you like. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. This webinar is considered a marketing communication and does not contain or should not be construed as containing investment advice or an investment recommendation. Now, in tonight's class, we're going to be looking at some live charts. These live charts have not been chosen as trading recommendations. We're going to be looking at the Euro-US dollar live chart, and that's my standard teaching chart. We're going to also be looking at other charts tonight because the specific patterns that I'm trying to teach you how to find are being exhibited on those assets. But they are not in any way a advice to trade that asset, and I have not even made a determination which way that asset will go. Now, in tonight's class, I'm going to provide you personal opinions and experiences. Now, I've been trading since the mid-70s. Yep, that long. I used to sit on the Chicago Board of Exchange and trade a private account back before, way before we had online trading. Okay, and we used to sit in the pips and we used to sit there all day long waiting for data to come from ticker tapes. We did hand charting, but the world was a slower place. The markets were slower, but we didn't have data feeds. We didn't have news service, you know, just to get economic events. And like I traded agriculturals. For me to find out what was happening with the orange juice crop in Brazil was a nightmare. But in order to trade, you had to know everything. So you had to develop friends and neighbors, because we didn't have fax machines. We didn't have computers, didn't have the internet. But today we have all those things. But trading is all about experience, knowledge, risk management, more experience, more knowledge, and more risk management. There are no super secret devices out there. There's no guru who's going to give you the secret way to make $1 million. Trading is hard work, and the more work you put into it and the more experience you have, the better the rewards will be. Now, in tonight's class, I'm going to use the term security, but I might say asset. I might say the euro, I might say Facebook, I might say Alibaba, but I'm not referring to any specific asset. Tonight, we're talking about concepts, and these concepts work for all publicly traded financial instruments in which an open market exists. Similarly, I intermix the term investing and trading. Now, over the years, I can't tell you how many comments I've gotten, how many emails I've gotten. People that have written really nasty emails saying, don't you know the difference between investing and trading? Why do you keep saying investing, investing, investing? Well, the fact is, I intermix the terms investing and trading. We know the difference. We're all here tonight because we are short-term traders. But it gets very, very, very boring saying trading, trading, trading 100 times in one class. So I mix the term investing and trading. But you all know what I'm talking about. You know the concepts we're talking about. You know what we're all here for. Now, a lot of people ask me all the time, what should I buy today? I got a very weird phone call just a couple days ago. My friend calling me, what should I do? What should I do? I said, what are you talking about? He said, Bitcoin, it broke $41,000. I said, oh, okay. I said, how much Bitcoin do you own? He said, oh, a portion of a Bitcoin. I said, well, I don't know what to tell you. I don't trade cryptocurrency. I don't follow Bitcoin. I only know what to tell you on assets that I watch and trade and follow every day. Because nobody can know everything there is about every asset. And people ask me all the time, what will the prices be tomorrow? What will they be next week? What should I buy? What should I sell? Well, wouldn't investing be easy if we knew the answers to these simple questions? But I don't have a crystal ball and I don't have a Ouija board. So if you're attending this class tonight in the hopes that technical analysis and interpreting price action on charts has the answer to these questions, I'm afraid it really doesn't either. Because as I said, there's no super secret sauce. But if you're attending this webinar with the hope that technical analysis will improve your investing or trading, whichever word you want to put in there, I've got good news for you. That it surely will. So let's get started talking about price action. Now, let's define or explain what price action is. To really understand price action means that you need to study what has happened in the past, then observe what is happening in the present, and then predict where the market will go next. Past, present, future. Too many traders try to ignore the past. When we talk about historical prices, it is critically important to understand the historical movement of an asset. And this is why most of your longer term traders only trade a handful of assets. Because you can't know everything about every asset out there. You can't be an expert in them all, and you can't know all that has happened. Like when my friend talked to me about Bitcoin, I had no idea. You call them and tell me the euros are 119 hedging up to 120. I can tell you, okay, last time it was in this area, this is what it did. It had a problem breaking through. 120.22 was a strategic number. 118.5 was because I know the history of how the euro moves in this area. I also have my charts. I have my support and resistance. I have all of my information. But we need to understand historical price with present price. And too many people are so concerned with making money that they really don't pay attention to the present price. They're only trying to predict the future price. Now, price action is among the most popular trading concepts. A trader who knows how to use price action the right way can often improve his performance and his way of looking at charts significantly. However, there's still a lot of misunderstanding and half-truths circulating that confuse traders and set them up for failure. So, what is price action? It's a favorite among short to medium-term traders. Price action trading brings together an interesting mix of information and different views. These include historic price patterns, technical indicators, and the investor's ability to read the markets. Many investors see the stock market as an information exchange, where all views and strategies meet and try to arrive at a fair price in the end. This explains why price action trading did not involve fundamental analysis of an individual market or commodity. Because to be honest with you, you and I as short-term traders, we couldn't give a hoot about the fair price of an asset. I don't care what Google's worth. I don't care what Alphabet's worth. I don't care that Google's going to introduce 20 new products over the next 10 years and revolutionize the mobile trading world. I don't care. What I care about is Google dropped down this morning, but it shouldn't have. It's going to recover this afternoon. And there's a pattern telling me that Google's going to move up to XXX price. That's all that I care about because we're short-term traders. So as many of these decisions associated with price action trading are subjective. What one investor may see as a breakout, another may see as a potential price reversal. Compare and contrast this with pure technical analysis, where you effectively ignore the experience of investors in favor of cold hard trends. Human nature dictates that futures and commodity prices can be extremely volatile. And that's what we're looking for. We're looking for, in short-term price action, we're looking for volatility of movement of an asset. An asset that's going to slowly move up over the next 2 weeks, 3 weeks, month, and we're able to get to the fair market value, or what the jobs report dictated it should be at. It doesn't matter to me. Okay, because by the 3 weeks from now, when the dollar hits 98, well, guess what? I've already been in the market a half dozen times. Overbought situations are often created because of fear and greed, while panic selling can take over in an event of disappointing news. These are types of scenarios where price action investment strategies can prove extremely lucrative. The key to reading price action charts is to take in short-term fluctuations. It's also critical to notice emerging trends and focus on patterns which repeat time and time again. You will hear talk of swing patterns, support and resistance, wave analysis, trend lines, and moving averages, to name a few different chart patterns. Candlesticks and bars are also popular types of charts. For example, when a chart is about to crash through a support level, it is unlikely to do it in one fell swoop. In other words, we know price moves and pushes and eases, push and ease, push and ease. When it comes up to a level of resistance, when price is moving up, it might have a lot of buying pressure and it might continue way past that level, but it's not going to, in most cases, it just doesn't ram through, because that's a strategic important level. There's been buyers who bought earlier who use that level to trigger their limit orders. There's other buyers who have set that level to get out of the market. There's other buyers who decide that price they're going to open sell orders. There's all kinds of things going on, okay, because that was a strategic level. So most of the time, even though the asset and the trend may continue straight up and continue with the momentum it had, it's going to, in most cases, stop for a second. Bouncing off the support levels, investors look to benefit from the short-term sell-off. As short-term traders sell into the bounce, buying interest begins to wane and sellers again take control. Eventually, the price will crash through the support level, often prompting an array of short selling. So how do we read price action charts? Well, there are many different types of price patterns we associate with price action trading. Some of these are fairly obvious, while others are open to interpretation. The following charts have been simplified to make a point. Once you understand what they really mean, you'll start to notice many of them as you look at charts every day. So there's things like bullish head and shoulders, bearish head and shoulders, engulfing patterns. Okay. Now, what's a bullish head and shoulders? Sometimes we call it an inverted head and shoulders, because we have a head and shoulders that's up, neckline, or we have a bullish head and shoulders, which is coming off of a downtrend and moving to an uptrend. Double bottoms and double tops. Once again, price falls down, the bottom comes back up, hits that, forms a resistance level, comes back up, and it formed two identical bottoms and each time bounced off. And I don't use double bottoms. I don't start looking at things until I have a triple bottom or triple top. So a triple bottom is the same thing, except it came down and hit that same level again, and this time, and bounced off at the same upper level, the same resistance level twice. And this time it breaks through. Then we have rounding bottoms. This is where price is kind of coming up to congestion, but all the bottoms, the lows of each push and ease are rounded out. And then we have bullish rectangles. We have bullish wedges. We have ascending triangles. Let's take a look at some live charts and let me show you these in live chart patterns. So let me pop up some open charts I have for us here. So here we have a rising wedge. I'm sorry, we have a rising channel. And we see price moving in this channel, but it hits its downtrend. And so what this was really a retracement, hits the resistance in the downtrend and breaks downward. In this case, though, our prediction was completely wrong because, see, we were predicting this move, but look what happened. We got that move. So they're not always right. Okay, here we had the same downward type channel with our resistance level here. And we came down, we bounced off, and we moved right, broke out that channel, and now we're looking at a breakout upward. But we had figured on a breakout downward, so we can be wrong quite often. But look at this prediction right here on Bitcoin. We've called that rise in Bitcoin when it rose from 19 all the way up to the 42s the other day. Here we see a breakout of the resistance pattern, and we got the breakout above, couldn't sustain it, and now it moved into a downtrend. So there are many ways that we can see reversal patterns, reversion patterns, but the ultimate part about trading price action is looking at price on the chart and looking at historical price, because these resistance levels aren't made up levels. These are resistance or support levels that have come from historic price movements when that asset has traded at this price in the past. So this resistance level we're getting here didn't just get created a few months ago. This resistance level has been every time that Ripple and the XTB is Ripple, yeah. No, that's XRP, whatever XPT was every time it's been trading at this level, what that resistance level was historically. So what are the price action trading strategies we can apply? The key to any successful price action trading is to remove peripheral noise such as fundamental data and look at price patterns, trends, and other forms of technical analysis. Now, you notice I haven't used the word technical indicators because price action traders like myself avoid technical indicators. We don't drop Bollinger Bands on our chart. Now, support and resistance does fall in the area of technical analysis. Trend lines, technical indicators. Trend lines are a technical indicator tool. But chart patterns are technical analysis tools, but they are chart patterns. But I use only things that go over top of price, because ultimately price action is all about reading the price on your chart, not looking below an indicator to tell you to do something. So when combined with good old-fashioned experience and a feel from the market, this can create a very successful investment strategy. Don't forget, even if you'd open a position based on any of the following price action trading strategies, you can also use technical data to set your stop loss and your limits. So one of the key aspects of price action trading when using support and resistance levels is the fact that once a support level is breached, it can then turn into a resistance or vice versa. Now, I've explained this in many classes, And so I keep trying to find and define these ways easier. I teach my class on support and resistance, and I throw out the word support, throw out the word resistance, and I just call them strategic price levels. But imagine price is on a journey. That journey includes a ladder. And sometimes price goes up the ladder, sometimes it comes down the ladder. And there's 12 steps on that ladder, say hypothetically. Okay, maybe it's a 15-step ladder. But as it moves up to the top of the ladder, it comes down. But when you step up on that first step, now you may be a young guy, not like me, and take it 2 steps at a time because you're in a rush. You may be a guy that's painting an outside building. You take 2 steps up with the brush and then step down 1 more step on the ladder and then move up to paint around the window, step down 2 steps. But if you think of each one of those steps as a level of importance, that when you stepped up, it supported you. When you were stepping down, it was also there. Okay. So that same level just reverses what it does, whether you're stepping up or stepping down. Now, it's worth noting that while traders tend to focus on volatile periods for trading, most of the time the markets tend to trade sideways, all within a relatively modest range. So support and resistance levels, again, imagine this is a ladder and you're stepping up the ladder. Hold on a second, let me get a marker on here. And here, you were climbing the ladder, you stepped up, you started painting the outside of that wall. You're at the top, not to the top of the ladder, but you're on whatever step you're on because that's where you got the bucket hanging. And then you stay painting down, step down to that ladder that supported you the last time. You step up, but now you need a little bit higher to get around the window pane. You go up here, and then you step down to where the bucket was again. And so this was a resistance level, but now it flipped into a support level. Okay, so just imagine that they are strategic levels that when price is coming down, it's important. When price is going up, it's important. Now, this class isn't about how to draw or find your support and resistance levels. We have whole classes on that. In fact, we have a whole 1-hour class in just understanding how to draw support and resistance from historic charts using swing highs and swing lows. Then we have other combinations of these steps up and down a ladder. Forget the support and resistance, but the movement. Some of these we call the pin bar, the inside bar combo. And this is seen as one of the most powerful technical indicators. As you will see from the example I'm going to show you, it can also prove extremely lucrative if you accurately recognize in time. The pin bar or the inside bar combination shows what is effectively a short-term sell-off before an exchange rate consolidates and then moves higher. If you look towards the start of this chart, you will see that the price bounces off the resistance level with the pin bar and the inside price action. So here we're looking at a chart with what we have is the pin bar. Okay, what is a pin bar? Some of us call it a mother bar. Some of us call it a bar that touched the resistance level. Okay, this is your pin bar. It's the bar that closed, that had the high or the low at that level. And then inside bars, many price action traders are extremely vigilant. They're always on the lookout for what are known as inside bar patterns. Okay. Now, these appear a zillion times a day on a chart, but it's only when it's at a strategic point that it becomes important. You can recognize these by the emergence of a shadowy bar within the body of the previous bar, or a new candle that appears within the body of the previous candle. Or what else do we call it? Sometimes we call it an engulfing candle. So we also call it a mother bar and an inside bar. The mother bar is the first bar that appears as a trend is coming down, and when that mother bar develops, you don't know that that mother bar is a mother bar until you get the inside bar, or we could call it the baby bar. because this baby bar is fully contained within the body of the previous mother bar or the candle, and it's of the opposite color of the mother bar. When that happens at a level of support and resistance, or a strategic price level, as we call them, we have something important to happen. The primary bar is sometimes described as a mother bar and will often indicate a period of consolidation and potential turning points from key support and resistance. This is the beginning of a changing trend and marks a downward movement. To see one mother bar and an inside bar occurrence is encouraging. To see two inside bars side by side is an even more indicator. So here we can see mother bar, inside bar, inside bar. This bar is fully contained with inside the body of this previous mother bar. And it happened at a key resistance level. So it is only when you take the time to understand how bar patterns emerge and what they indicate that you can position your trades. Don't forget to also keep an eye on the stop loss limit. As you'll gather from all of the information, price action trading is based around trends and momentum. The idea is simple. Once a trend changes, then the momentum often grows. It is only when a stronger or an opposing trend emerges that the direction changes again. So the whole idea is spotting a trend change, because it takes momentum to start a movement, start a trend. And once that stone starts to gather the moss, or that hamster starts spinning his wheel around, it's very hard to slow it down. So when we can start to see it early and start to see it spin, well, once it gathers the momentum, it's hard to slow down. So we can get into an high probability trade. So in between these relatively strong trends, there are also periods of consolidation. Sideways trading and the prices will often bounce off of tightly drawn support and resistance lines. In many ways, support and resistance levels are self-fulfilling prophecies. Many traders now use technical analysis and take them into consideration. However, price action trading offers the best of both worlds, with both technical analysis and human input from a trader. Don't take action with a trade until the market itself confirms your opinion. Being a little late in a trade is insurance that your opinion is correct. In other words, don't be an impatient trader. Don't be a trendsetter. Don't be the guy in the front of the pack. Wait for a confirmation of your trade. Wait for a volume to support your trade, and wait one more bar, one more candle. So there are numerous disadvantages and advantages when using price action trading strategies. And the ultimate it comes down to is how disciplined you are as a trader. Some of the disadvantages include you'll only get a relatively small amount of trades. And that's the whole thing. If you can get your enjoyment from analyzing the markets and analyzing charts, and not your enjoyment from actually making a trade, because for me, the actual trade is the end of the satisfaction. It's not the beginning of the satisfaction. Say you're, a World Cup, a world, championship, let's say a quarterback, football team, U.S. football. Okay. And you win Sunday's game. You get out there, the game lasts for 4 quarters. It goes on 15 minutes a quarter. The whole thing, between halftime and everything else, a couple hours. And your team wins. You did some magnificent passing. You got an applause. Everybody was happy. You won the game. You're in the locker room. Everybody's happy. Popping champagne. Everybody's patting you on the back. You're the world's greatest quarterback. Well, if that's all you wanted, and you just showed up on Sunday, you'd eventually be the world's worst quarterback. But if you were the guy who spent all week long studying, rehearsing, practicing scrimmages, working out, learning every play, everything that's going on, proving everything. Sunday's win was just the end result of your whole week's worth of work. So your satisfaction wasn't the 2 hours or the 4 hours on the field. It was a whole week of drawing satisfaction. It makes it a lot more rewarding. Okay. Now, having the discipline to make yourself do that. But I spend days and days. Sometimes I get so lost on charts and setups, I forget to trade. Now, unfortunately, trading using price action trading are often caught out by significant shifts in the market. This often means price do not return to their preferred trading levels. For those lacking discipline, they could end up chasing the price higher and higher. Meanwhile, for those who are able to remain focused on the technical situation, opportunities will emerge. There are many strategies we mentioned. Above all, be overcautious when waiting for a definitive change in the trend. There can be times when intraday prices could spike above resistance or below support and then recover. This could be false flags and can be potentially expensive in the long run. When looking at chart patterns, not all traders have the same opinion. Some will go long while others will go short. These decisions are based on their opinion of the technical analysis opposed to the fundamentals. Whether you are actually ignoring the fundamentals is debatable because, in theory, contract prices today should reflect all the information that's in the public domain. Basically, let the market talk and listen to what they are saying. Now, I'm not saying be a technical trader entirely. Ignore the fundamentals. No. But what I do is in the morning, I look at my economics calendar. I look at the financial headlines. I look at the political headlines, and I've got a clock in my head. I know that there's an event taking place, a strategic event, whether it's a meeting, a central bank meeting, whether it's a jobs report, whatever it might be. And it's happening at 11 o'clock, and there's another strategic point at 3 o'clock. I know it's the middle of the night and Donald Trump's sleeping, so he can't tweet anymore anyway, but he's not raising the markets. And I know it's the middle of the night in the Middle East, so there's nothing going crazy in the Middle East. And I don't need to look at the fundamentals. I don't need to see the headlines. I don't really care whether the jobs report came in better than expected or worse than expected. Because if I know, I'm looking at my charts and I know that the jobs report's due at 11, I can see in my charts that it's getting ready. I can see the market taking move, and I can then look at the market volatility and see, that report was a lot worse than expected. It was a lot better, but I don't care. Okay, what I care about are price movements that give me a potential to make a trade. So what price action trading can we look at? Well, as we touched, while price action trading is based on technical analysis and reading of the situation, it's not always cut and dry. After hitting a new high, an exchange rate falls back as a result of profit taking. While it will depend on the support and resistance levels, one trader may expect a double top and then move to higher ground. However, a different trader may see it as a start of a new downward trend. In this scenario, continued profit taking could push the price below the support level. Well, we have to understand, if a price was way too high and we had a market sell-off, doesn't mean the trend is over. It might mean that it reached a huge amount of market momentum. Again, Bitcoin, when it hit 40,000, even though it went through there and went to 42, we knew it was having a big sell-off because we knew that was the highest price it ever been. It was strategically important, and people were selling like crazy. And what to do? The next day, it fell all the way down to 31. And now it's re-picked up its momentum. And I think when I looked a little while ago, it was about 35,000. And it's probably going to plateau out there for a while. But it was a classic. One classic indicator that a trend is changing is high trading volume. So if the price is stuck in a range bound bouncing between resistance and support, under relatively low volumes, one investor may see this as a trading opportunity, while another investor may see it a lack of interest and assume a likely break through the support level at some point. I don't assume either. I assume whatever price does, I can tell whether the market is supporting it or not by seeing the shift in volume. So the simple answer to this question is yes, in the right hands. Price action strategies can highlight periods of consolidation, the emergence of new trends, and phases of sideways trading. The key is to see what's in front of you as opposed to trying to manipulate the chart data into what you want to see. The basic difference is that price action incorporates both technical analysis and human input. Effectively, you are monitoring emerging trends and reading these with varying degrees of discipline and experience. Remember in the very beginning, I told you trading is about knowledge, experience, risk management. More knowledge, more experience, risk management. More knowledge, more experience, more risk management. Okay. The more you have, the better you will become. And it's for one of the reasons, again, that trading just a handful of assets and staying within one market is much more beneficial. Okay, because you'll be able to feel the price action. You'll understand what is happening. You'll know those assets inside and out. While there is a degree of human input with regards to price action trading, there's also a need to be disciplined even if you're marginally miss out on several trades. The idea is blunt. When the turning point occurs and the momentum builds for a new trend, you will be there. Remember, the market offers continuous opportunities. Sitting back and saying, I missed that chance, I missed that chance, I missed. No. If you didn't trade an asset because you didn't see something, or you saw something and didn't think it gave you a viable trade or was too high risk, there's no problem because there's always going to be another opportunity. But when you see an asset move and you missed the opportunity, it becomes a learning opportunity. Because what you should be doing is looking at your chart and saying, what didn't I see? What should I be looking for next time so that I can see when this action is happening? And what did happen here? Make each time a learning experience. And then you'll find that you will become an experienced price action trader who, with simple patterns, support and resistance lines, trend lines, will be able to make intelligent decisions and filter out good trades from bad and make high probability trades without getting yourself all involved in these complex technical indicators and making your strategy and your life so different, so difficult. Come up with a couple trade setups, what you're looking for, how you'll confirm it, what you will do when this, and this happens. Then, because most important, after you figured your trade, okay, I'm going to trade this. Now it's figuring where your take profit should be, where you need to put your stop loss, calculating your risk reward ratio, because a lot of times you'll have the perfect opportunity, but when you calculate your risk reward ratio, you find it's outside your acceptable risk reward ratio. So therefore you don't make that trade, because the whole idea is finding an opportunity and then filtering it out so that you don't make bad trades, or you limit the losing trades, because we're all going to have losing trades, and you make sure you limit your loss at all times. Risk management, experience, knowledge, risk management, experience, knowledge. And remember, there's always another opportunity. A zillion a day, God knows how many a day. There's always another chance tomorrow. It's not like it's a once in a lifetime opportunity you'll never get again. And never kick yourself in the back of the head for missing one of these, and never kick yourself in the back of the head for getting out of the market at a safe point where you would set up your trade, not saying, oh, I bought Bitcoin at 13,000, I sold it at 32, and I could have stayed in there till 42. I missed all that profit. No, you didn't. You made all the profit. You made exactly what you wanted to make. Okay. And that's it. Set your parameters, be disciplined, and be cautious. So thank you very much for joining us. And please watch all of our videos on support and resistance trading, chart pattern trading. We have lots and lots of these broken down in 1-hour classes that specialize in each of the things we've talked about so that you can become a solid trader. Bye now. Have a great night.